Hi everyone, thank you for joining today's live Tearsheet review with Dr. Jessica Stauth. As always, today's webinar will be recorded and made available on our Quantopian YouTube channel for further viewing. If you submitted a Tearsheet and we do not get to it today, don't worry because we'll be holding similar webinars in the future. So Jess and her team are in charge of selecting the algorithms from the Quantopian community for our portfolio. Previously, she has worked as an equity quant analyst at the Starmine Corporation and as a director of quant product strategy for Thomson Reuters prior to joining Quantopian in August 2013. Jess holds a PhD from UC Berkeley in biophysics. Thanks, Jess.
All right, thank you, Paige. I'm going to assume everyone can hear me and see my screen because that never gets screwed up. All right, so first off, just wanted to say thanks for everybody on the call who submitted tear sheets. It was a really nice selection of work that was submitted. I was excited to go through all the tear sheets, and I'm going to give you guys some feedback, but I'd love to keep the conversation going in that thread on the forums. I'll certainly try to get to questions today, but if we don't get to questions, all of your questions today, I'd love to just keep the discussion going in the forums thread. In these slides, I sort of grabbed some highlights of things I thought would be interesting to talk about, but we'll sort of see how it goes. And I also have my notebooks open with all the full tear sheets that you submitted, so I may jump back and forth. We'll see kind of how that goes. So first off, sort of disclaimers. So as I went through this exercise, I realized it would be important to sort of couch the feedback that I'm going to give in kind of what it will and won't cover. So I'm going to base the feedback today just on the data that was accessible to me in the tear sheets, notebooks that you guys shared on the forums thread. So for example, folks chose whatever length backtest they wanted to share. I'm going to give feedback on the length of the backtest that you shared. I also realized that I don't think it's transparent to me in the tear sheet what you used as a capital base and a cost model. I think I could have found that internally some way, but I just basically am assuming that you used something like what the contest defaults are. So I'm sort of assuming you used something like a $10 million capital base and our default 5 basis point fixed cost model. So if you didn't use that, use something different, feel free to chime in the questions. We can sort of talk about that. I'm also not going to go into a ton of detailed feedback about, sort of my take on the economic rationales that you did or didn't provide. It's awesome for those of you who provided them. If we have time, I'll sort of talk a little bit about like why I think that's important at a high level. And I think it's totally correct, as someone pointed out on the thread. At scale, it's going to be really difficult for us to exactly quantitatively sort of evaluate on those rationales. I view them as a requirement more for doing good research and something that's helpful to any quant researcher looking to try to find and exploit anomalies in the market. My viewpoint is just that starting from hypothesis-driven research is the way to go, and so it's the view that I want to kind of share. And I guess that leads into my last disclaimer. So this feedback is based on sort of mine and I guess broadly Quantopian's perspective. So that has, is anchored in sort of the style of investment that we're approaching, the characteristics, the preferences, the limitations that come with that. So, my opinions are not to say that, there are not many right ways of doing things, but this is sort of the feedback I have thinking about as I look across strategies that folks develop on the Quantopian platform and try to find which ones might be a good fit for our investment process. In order to receive allocations inside of one of our vehicles. All right, so with all of those disclaimers, actually wanted to give sort of one other just very high level of feedback. So the tear sheets submitted on this thread really all looked quite excellent, I would say. So I think if you've been in the Quantopian community for, I've been at the company for about 5 years. If you go back and think about where we were 5 years ago, we were talking a lot about hey, here's why it makes sense to do market neutral investing or to design strategies that are alpha seeking and not just following the market, right? So here's what a good Sharpe ratio looks like. Here's what good performance stats look like. So we've kind of addressed all of those problems, I think I would say, at least in this cohort of algos that are submitted. So you're going to sort of hear me say probably about each algo, like the performance looks great. So I'm not going to do a lot of nitpicking on saying, oh, I think this or that algo could have better performance. Instead, I'm going to try to highlight some themes of areas where I think broadly that we can still improve sort of as a community, and some of the things that just I've seen with the experience of going through a year of live trading strategies we've selected from the community. But overall, I would say really, really nice work. So let me look. Oh, so the other thing I did was I decided to go through the algos in the chronological order that you guys submitted them, so that in case we do run out of time, I don't think that we will, I would sort of have done the best service to those of you waiting the longest to get feedback on your tear sheet. But then in this presentation, where I'm sort of pulling out little snippets, I didn't put your names in them, so I just numbered them algo 1 through algo 9, which were sort of chronologically how I went through them in the thread. Okay, so here's the first algo. So this was Will's, and I think Will is on the call. So again, Will, your algo looks great, really solid performance, very consistent. There were no down years. The position concentrations look pretty good. So spoiler alert, that's going to be something that's a theme I'm going to talk about is, I think on the whole, something that Quantopian community can continue to work on, and we probably need to continue to make this faster and easier, is bigger dynamic universes, lowering position concentrations would be a positive thing. So really well-controlled market exposures. I noticed that on some days, so the number of holdings were really pretty consistent overall at something around 150 positions, but sometimes that number jumped up. So, if we were sort of having a direct conversation, I would ask, oh, hey, how do you exactly determine, the size of the invested portfolio? So what I did notice was that on rebalance days, the turnover is really high. So let me skip to this first. So this is going to be another theme. I think we have more to do at Quantopian to continue to improve how conservative our cost model is and how we quantify turnover. We talk a lot about average daily turnover. And so you can see here, the average daily turnover for this strategy looks like about 13%. So about 13% of your capital is turning over every day, which maybe doesn't sound that high, but then when you look at what's happening on a rebalance day or when the algo is trading, you're sometimes having 100% turnover. So in practice, that's really high. And I think that's probably would be, sort of the biggest red flag that I would have about this strategy. Then if we hop back, so I'll show for the first, I think 3 or 4 algos, I'll highlight this style factor exposures plot over time. So, I think what is nice here is you can see these exposures are dynamic, but if you sort of squint, you do say, well, there are sort of these bands, right? So pretty persistently, this strategy is deciding to take a positive exposure to short-term reversal. And, not 100% of the time, but fairly persistently, it's taking its largest short exposure to volatility. So not necessarily anything wrong with that, but that would be something I would observe. So looking at sort of what my questions were and my notes here, and this is a question that I think I'm going to ask probably on every single algo, and it's something that I think I'm going to come back to at the end, which is the way that we think about holdout data at Quantopian. So I guess at a high level, the 2 biggest problems when you see a backtest that looks good, which all of these are that we're going to review today, you sort of say to yourself, this is great. So I'm basically in business. Okay, I can allocate some capital to this strategy and it's going to work, right? Okay, great. If the answer is no, the 2 most common reasons are either number 1, because the model looks good only on that in-sample data that it was sort of trained on, and it's just not going to work going forward. It's not going to generalize to new data. Or number 2, it's not that it's overfit, but it's trained on data where it didn't have a really solid estimate of its costs. And out of sample, that cost function is going to turn out to look different than what was modeled. And those are sort of the 2 very most common failure modes are either model's not going to generalize to new data or model's not going to work on cost. So the not going to work on cost, we can kind of deterministically keep making our cost model more sophisticated and more conservative. And we've got some internal work that we're getting ready, I think, hopefully in the not too distant future to upgrade our 5 basis point fixed model to something that knows a bit more about, per position liquidity. But the overfitting piece is just incredibly difficult to address. So how we've chosen to do that internally to get started is to just say, well, hey, we're going to have to assume that folks basically fit on all historical data up to and until they press backtest. So we're then going to basically have to wait for out of sample data to accumulate subsequent to the backtest being run. That might mean we have to wait 6 or 12 or 18 months and then say, is the strategy working? Now, that's not a very efficient way for a researcher to do their research, right? So you can't really have a meaningful workflow where you develop your model, you work on it, and then you put it on the shelf and you go away and age yourself 18 months and come back and check on it. So really, what I think I'd like to see us continue to provide better tools to do this, but there's nothing stopping folks in the community from doing this themselves right now, which is, I think that to the extent you want to be building more robust models that are really likely to work in the future, what you should be doing is looking at holding a lot of data aside from your model development. So there's a lot of different ways you can think about that. There's a lot of resources out there for thinking about the right way to do it. So some folks hold out, fully half of the historical data available to them in a continuous fashion. So some folks hold out every other year or some subset of years, some subset of quarters, some subset of months. But basically something I would encourage everybody to do is to just be thinking about how to prove to yourself that your model is going to generalize to new data. The last thing I'd say on this one, and you'll see, I'll look at the style exposures for the first couple. I think it also can be interesting to say, let's say I have a persistent or fairly persistent long exposure to like short-term reversal. Just kind of making sure like that's your sanity check for like, well, is that how you built the model? Is there something in there that sort of banks on, prices reverting? And, what's the sort of edge over and above the basic short-term reversal signal that you feel like you have? So that's sort of the kind of thing that, we look at as we go to add additional algos to our portfolio is, okay, well, how much coverage do we already have of sort of a short-term exposure, style exposure, and in what way do we continue to sort of get a diversified exposure to different variations of that? All right, so I think that was my main feedback. All right, so Grant was the second person to submit a strategy, and I'm not looking at the attendees list, so I'm going to guess maybe Grant is on. So again, great performance from the strategy. So something nice here, and I don't know if I put it in, I didn't. So the turnover in Grant's algo is really, really consistent. So his turnover is something like 15% of our average daily turnover, and it doesn't go way above that on any given day. So it's nice as you can sort of look and say, okay, great, it's 15% turnover on average and at peak. So, that seems very reasonable. Now, I don't know if I highlighted this in Will's strategy, but he had been trading, I think I did say this at the beginning. So Will's strategy, and I have a summary to tie these all together at the end. He was holding between 150 and 200 positions, so he was ending up with a position concentrations that were sort of all well below 2%. So I think one of the challenges here with Grant's strategy in terms of scale is that we're trading a much more concentrated portfolio. So there's something like on average about 32 positions. And now let's look here at the style exposure. So sorry, it's a little bit blurry. I just kind of grabbed screenshots and blew them up. So now you'll notice actually pretty similar style exposures to Will's strategy that we looked at previously. So, definitely jumps around and is dynamic, which is great, taking different exposures. But if you squint and you sort of had to say what are the most persistent exposures, you'd say most persistent is being long a short-term reversal and being short, in this case, more so size, but also to some degree volatility. So I think there, the concern with that really is just sort of, again, does it make sense to look at what's the model adding over and above sort of a basic short-term reversal signal, and are you happy with taking on that level of short exposure to, say, size? Does that make sense? But I think the biggest thing here is just, hey, the strategy looks like it's plausible that it works. So it would certainly be more compelling at a larger portfolio size. And if there's a strategy under the hood that's ranking sort of a much broader universe, I would definitely look at the benefit of having a more diversified portfolio. So the way I tend to think about it is we're writing these models that sort of, their edge is that they know, kind of consistently a bit of information about, many stocks at once. And that's sort of the edge we're trying to exploit. And it always looks attractive to sort of, even if you rank things, say, oh, well, I think the alpha is concentrated in the tails and let me like only trade my most powerful signals. The problem with that is, of course, the trade-off is, you're exposing yourself to a lot more idiosyncratic risk. So something your model doesn't know about, like, Facebook announcing that they are going to put privacy first, for example, and cratering their stock price overnight, your model's not going to know anything about that, right? And so if you're holding Facebook at a 5% or 10% concentration, your model has no hope of avoiding that idiosyncratic event. Whereas if you've got a 1,000 stock portfolio, something unforeseen like that happens to Facebook, and it's a non-event for your model. All right, so third algo in a row where we can sort of say, oh, that looks familiar. We're long short-term reversal, and we're short size and volume. So I think this is James's strategy. So again, like I should say, the performance stats all look great. But again, my main sort of feedback points would be, the portfolio is pretty concentrated. So I think this strategy also holds on average about 32 positions, also has about 15% turnover, both on an average and a peak basis. And then I think with this strategy, I just sort of grabbed the tabular results from the performance attribution. So you can sort of just scan along and say, oh yeah, okay, average risk factor exposure. Here's where you can kind of see, like, on average, what stands out is, being long short-term reversal and short volatility and short size. So my same feedback to James as what I gave to Grant would be, I think it would be really interesting to look if you can take your same model. And so actually, specifically, I know that James mentioned in his post that his economic rationale was to specifically be looking at creating a stat arb portfolio. So then I'd say really specifically on that, if you ask sort of a traditional stat arb portfolio manager, what do you think is a reasonable position concentration? They'd definitely be thinking of something, down to 0.5% probably, or even less. So I'd definitely say it would be interesting to look at how your strategy would look at a much larger universe or much larger portfolio size. I think you'd see sort of some hit probably on the back-tested performance, but it would likely make the strategy both more stable and more scalable when it ultimately had capital deployed against it. So that would be my advice on this one. All right, so sailing right along. Now, I apologize that, I'm taking you guys tear sheets, and I don't know how the colors are randomly assigned each time. It would clearly be nice if short-term reversal was always one color, but we go with what we go with. So here we've got a new ordering. So this is Verdean Hawk, and I think Verdean, whoever you are, submitted 2 different strategies. I didn't give a ton of feedback on the second, but I can try to follow up with that. It was actually really good. The second strategy you shared sort of got at some of the interesting corner cases around how an algo can get ranked really nicely in the contest, even if a sort of equity curve doesn't look so great or so compelling. So I think that's interesting. I'll try to follow up a little bit more with my thoughts on the thread, but focusing on this strategy, which is the first one you submitted. So we're seeing like a different ranking of style exposures. So that's cool, right? Because if I'm trying to build a portfolio, and if we're sort of saying, a lot of strategies folks build are going to be sort of taking some type of, maybe one of these 5 styles or themes and then making it their own and changing it and working on it. Still, maybe you're kind of around one of these style ideas. And so if anything, like this strategy is doing something different, definitely we would say, or I would think, from the first 3 that we looked at. But what it's doing that's the same is it holds about 34 positions. So same feedback of, that's a really concentrated portfolio sort of out there in quant land. Turnover wise, did I pull that in? No. Okay, so turnover wise, about 18% turnover for average daily turnover, but this strategy also is not quite as consistent as the last two. So the turnover can peak to as much as 40% in any one day. So that also looks on the high side. Then what I wrote down, so here again, just sort of highlights, okay, yeah, like there's the style exposures that are sort of the most persistent and noticeable. Fine, that makes sense. And then actually, I think that the author mentioned this in the post. So sort of based on the economic rationale, it's not surprising that there's this fairly persistent long exposure to tech. And I think it was sort of also part and parcel of the approach that results in the sort of fairly persistent short exposure to consumer cyclical. And so I think the author was saying like, hey, that's kind of like one of the remaining issues. So I'd agree with that. I think that best feedback on this strategy would be to, try to think about how to rein in and hedge those sector exposures, whether it's with a sector ETF is one approach, or the other approach is, whatever you're using to sort of decide. I think this one might be the one where the economic rationale was like disruptors and disruptees. So if there's a way to think about those baskets you're creating and sort of re-rank or neutralize them, let's say within sectors. So if you can find some way to actually say, okay, well, here's like within tech, I'm going to separate the world into, disruptors and disruptees, as opposed to necessarily like maybe here, I would say from a distance, it kind of looks like kind of one bet, right, on the tech's going to keep going up and consumer cyclical is going to keep going down. So why is that bad, right? So as I was kind of thinking about like how to explain like why we don't like this, I think there's kind of like two core reasons. So if you step back, like, well, okay, why don't people want a quant strategy that takes persistent sector bets? And the reasons that I can come up with or think is sort of number one, those exposures, if they're persistent and kind of static, they can be cheaply had, either long or short by investing in a sector ETF directly. So if I want, tech exposure, I can go get it and I'm not going to be paying, hedge fund fees. So that's sort of one answer. The other answer, though, is that what you're trying to do is really figure out, does this, and either I am trying to, or you as the author are trying to convince yourself, do I really have some edge here that's like a stock selection edge or an alpha, right? Like an edge beyond this observation that, tech just keeps going up. And it can be tough, even with performance attribution and a risk model applied this way, it can be tough to sort of tease that out when you have this persistent exposures to sectors. So I think this is something that you could look at also on the research platform in the Alpha Lens library, where maybe you could take your signal and just look at it again on tech companies and see, hey, if I just rank the world of tech companies, can I come up with, some kind of more neutralized basket? So that's sort of giving the same feedback, maybe 6 different ways, but just to be over the top about it. So I skipped Algo 5 because, like I said, that's the second one in my accounting system here that Verdean Hawk submitted. So if we get to it, I'll talk a little bit about it at the end, but I think I might just talk about it more on the thread because it's sort of like saying, again, yeah, like why does a strategy that doesn't have such great returns still look good in the contest? So Algo 6 is Brian Richardson. So, again, the performance looks awesome. Nice here, and let's see if I put it second. So I love, like, it's so funny, like when you're thinking about kind of stat arb type strategies or things where you're really trying to do stock selection, actually, like, I love plots that kind of look like white noise, which I think these do a little bit. So what you're kind of seeing is like, hey, this strategy is like making a lot of different exposure decisions. They're managed within some bounds, but they're like very dynamic. So on any given day, this strategy is kind of like just as likely to be, long or short tech or long or short volatility or short-term reversal. It's bounded and it's not persistent, right? So if it's a strategy that works, like it's being very active, right? So that's cool. That's interesting. biggest concern probably, which is what I had put first. So this is the highest turnover strategy that was submitted. So this strategy holds 75 positions. So I'm still kind of highlighting that as like sub 100 as being a concentrated portfolio, but definitely, obviously, it's sort of half as concentrated as the 30 some odd stock portfolios we were looking at. But what really stands out is the turnover. So here we're got an average turnover of about 64% a day that peaks at 100. That's super high, and I just know in practice that's going to be really hard to overcome. You have to have such high returns expectations and forecasts. That's going to be a big hurdle to overcome. So that, I think, is my highest kind of priority feedback on this one. Is I'd look at why are your alphas so fast? And can you preserve your expected return, or can you preserve like good results if you try to slow things down, by a factor of 2 or 3? I think, yeah. So just looking over my notes, they were, hey, would be awesome to see, twice as big of a universe with half as much turnover. But overall, this one is really, really nice. The Sharp is really, really good. Like basically, the Sharp looks so good that it's almost like one of these red flags where you say, you know what, our cost model is probably not dinging you to the extent that it really should. However, what's cool about that is it means like, even if that Sharp is like twice what you could really realize, you still have a good Sharp left over at the end of the day. So definitely, like, whatever the design of this is, looks really compelling. I think I would just look at, making it a little more realistic would probably involve, again, increasing the size of the book and dialing down the turnover to the extent you can. All right, making really good progress here. All right, so Alan's strategy is number 7. My first note that I wrote down is looking at is "I like it!" exclamation point. So it's good. So basically, I had the same kind of concerns that I could come up with here, which is average turnover. Again, sort of average daily turnover like doesn't look that high. So it looks like, have these on different note pages. Average daily turnover looks like about 10%. But when we look at what's actually happening on days that the strategy is trading, it may be turning over its book 100%. So again, there's nothing inherently wrong with that. It's just that, I sort of know from experience of now as having done this, that that's going to really limit how much capital you could put in this strategy to sort of turn over 100% of the dollars in it. It's going to become expensive, and you need to have really high returns expectation in order to overcome that cost. And then did I put in the sector? Oh yeah, okay. So sector and style exposures. So the nice thing is, like, you can see the strategy is sort of taking bets, but they're not extremely persistent. They're sort of stair-stepping in and out of choosing, sort of either explicitly or implicitly choosing to be long or short a given sector or a given style, and they're bounded. And again, I actually would say back to that theme of, the quality and sort of the construction of all the strategies submitted on this thread is, I think, kind of like miles ahead of maybe where we were a few years ago, in that clearly everybody is looking at these plots, I think, and sort of being cognizant and thinking about, well, how am I bounding this? So it's thoughtful, which I think is really, really good. So the sort of most persistent that I could see exposures was that strategy is typically more short momentum, for example. So does that make sense? It's not necessarily bad. I'd want to kind of match, like, does that make sense with what you think the strategy is doing? But the alpha looks very good. So 8 on our list was Joaquin. So the performance looks really good. And I think you mentioned in the post that your concern was sort of that I forget if, it was sort of a profitability statistic or hit rate or what on the short side was sort of what you thought was the kind of remaining thing that would need to be fixed. So I would not personally be overly concerned about that. That's something that I know I myself would look at a bunch. And I remember at some point, someone who was smarter and knew more than me in the field kind of pointing out, Right, but you're looking at a particular 10-year time period for which the market has only gone up, and all shorts have basically, on average, lost money. So I really wouldn't be that stressed about it. I didn't have time to grab a picture, but I wanted to sort of throw in here a plot of, or maybe did I? Oh yeah, okay, I did. So take a step back, right, and look at sort of how nice this equity curve looks like, and say like, wow, if I just showed you that in isolation, you would say, this is great, right? I would like to invest all my money in that green line. And then I tell you, oh, guess what? With the benefit of, look ahead, you are going to know that the market is just basically only going to go up for 10 years straight at like a crazy rate. So, okay, yeah, this is like a long bull market, and it's kind of good context for us to have. And there are still a lot of investors out there who would be very happy to pay for exposure to that green line, even though in the background, the market has done quite well. So I wouldn't be too worried about that. Other things that I liked about this strategy was that this strategy is holding sort of in chronological order the largest portfolio size that we've seen so far. So holds about 400 names on average. I thought that was great. Like that's the right direction you want to go in. Better diversification. Average turnover was around 15%. Peak turnover wasn't too much higher at around 20%. So I think on kind of like the sane end of things. Kind of the main thing here I'd say is just like that green equity curve looks like so good. Again, to sort of think about what choices you made and how much you used all of the data that's here and how confident you feel that it'll generalize to new data going forward. So if you hadn't used some amount of the data prior to this to look at, and you can consider that sort of your own out of sample, I'd go back and look at that separately and cleanly and try to convince yourself, that the strategy, if you have more data you can look at, sort of does as well on data you haven't, looked at as alongside data you have. It's really hard to exactly tease that out after the fact if you haven't baked that into your research process on the way in. So the last strategy that I looked at was Leo's, the performance of which also looks great. So, nobody submitted algos that lost lots of money to the thread, which I think makes sense. So this was the largest portfolio size, and I think Leo and I have spoken about his strategy as well, so I felt like it had some more good background. This strategy is holding about 1,000 positions. That's awesome. That's a really well-diversified book. So if there's alpha in it, what it tells me as someone looking at thinking about making an allocation to it is something idiosyncratic, comes in and comes along, and Elon Musk tweets something stupid, or Mark Zuckerberg, says something stupid, or some other CEO does something smart. That's not going to ruin my day. That's like the way I want to think about it. You want to manage a nice, large, well-diversified quant portfolio. You don't want to be subject to the whims of, an earnings announcement coming in or a daily news event that your model is really, has no hope of picking up on. So love the large portfolio size. This strategy turned over an average of about 7%, with peaking around 20%. So again, that seems sort of on the reasonable end of the spectrum, at least with the ones we sort of looked through today. And we're looking at the sector and style exposures. So, they're again bounded, and if you kind of squint, there's nothing that's like particularly strongly persistent in an exposure one direction or the other. So I sort of can't give a ton of feedback on, I'd hedge this or hedge that out. So I thought it looked good. And again, sort of same feedback of, and I think Leo and I gave him this feedback directly one-on-one is, hey, it can be really tricky to spot, how much you've mined your data that you've looked at. And so I think I sort of know, with benefit of more insight on this strategy, that there are a bunch of different components that have been researched separately and then put together. That's fantastic. That's the way to design a really good strategy, is to sort of start with building blocks and build them up, but also means that at every step, as you're choosing your building blocks and choosing how to combine them, each of those is an opportunity to sort of tune your algo to look really good, and to sort of make decisions that are based sort of on how the performance looks. And that can seem innocuous until you roll things forward and the world doesn't look exactly the same way going forward. So that's the same feedback to everybody is I can't look right now. I don't have like the best tools yet to sort of exactly try to think about, how much data mining or fitting folks are doing. And so we've taken this like very conservative stance for now of assuming almost that you guys are fitting on historical data and then waiting to see how things work in out of sample. But one thing we've been thinking about a lot is, how can we make it easier to put sort of best practices and tools in the community's hands so you guys have like a better default state to try to kind of help you hold data out. And then also, can we sort of look and even try to sort of reward that good behavior on the platform of folks that either really are holding out their own data or are showing a lot of, restraint in terms of the way they research or backtest. So that's something I think we can continue to do better on. All right, so then there's a lot of analyses I would love to kind of do across this whole cohort. Like I said and kind of disclaimed at the outset, I did not go and grab the source data for all these algos and perform a bunch of comparative analyses, and I didn't go and sort of run all the pairwise correlations. I can look at whether I can do some of those things sort of as follow-up. But one thing that I noticed just as I was like going through them in order was, again, these kind of like thematic areas that like I have already seen in the strategies we've selected and allocated to in terms of some things that have differentiated, not necessarily performance, but I guess just differentiated like strategies that have kind of looked robust or behaved in a sensible way, kind of like how we might expect, and things that could be improved. And the two biggest kind of quantifiable thematic areas that I came up with were portfolios, like sort of concentrated portfolios or single position concentration and turnover. So at a high level, I thought it was kind of interesting to just pull all the algos back together here in a little summary table. So this is the 1 to 9 in the order that I went through them, and to say, okay, what is the average position count? Sort of then let's assume everybody does like 1 over n, right? What's the position concentration across these 9? And so I highlighted everybody who's under 100 and said, let's call that sort of concentrated. So, sort of fully half of you submitted what I would call kind of concentrated portfolios. And my feedback to you is, look at how you might broaden that. And then what I think is interesting is I think we're going to have to think about providing you guys with more and better both turnover metrics and cost assessments. But if you look on an average daily turnover basis, there's sort of one strategy that really kind of shows up as like quite high to me. But then what I thought was interesting too is if you instead sort of say, oh, well, maybe the average daily turnover is not representative for some types of strategies that rebalance like in a more episodic way, then you see 3 strategies that sort of stand out as, oh wow, on some days, I'm kind of trading my whole portfolio, which is going to be pretty limiting. So those are my 2 really high level thematic areas that are quantifiable. Then my third area that's very difficult to quantify is just sort of that one on thinking carefully about how much of the historical data that's available to you have you used to make decisions about what components to include, how to include them, how to combine them. And if you have held data out, that's fantastic. If you've held data out sort of just, sort of by accident because you've been focused on recent data, I'd encourage you to sort of decide whether you like where your model is and you feel like it's at a sort of final place. Then I'd encourage you to, sort of test yourself, go back and look at a several year period over which, you have not run your strategy, and look and see whether the performance is markedly different. If it is, I would say like, sure, you can sort of do an exercise where you kind of rationalize that and say, well, that was a different market regime, this, that, the other thing, but be careful about that. And if your strategy's performance looks markedly different over a set of time that you haven't researched yet, then I would that would raise a red flag for me. And if you haven't held out more data, then what I would do is sort of the other thing you can do to try to check yourself on kind of fitting or finding like little local maxima is to say, okay, well, let me take a step back. I know the components that I put together. I think it seems to me from reading the descriptions, like many of you are taking this modular approach where you're identifying different components that you can sort of look at, decide, you think are predictive, and then combine them in some way, which is great and I think is a successful way to do things. So what you can do is take those different components and look at them each one at a time. I would go into the research platform again and use the AlphaLens library. And what you can do is look and say, okay, does this factor sort of persistently show predictive power across a wider swath of stocks than those I'm investing in? So, if you sort of look and say, oh, wow, I've picked this portfolio right at the tails that has really nice performance, but wow, that is a very non-linear relationship in the stocks that I'm ranking. That's sort of a red flag. And so if you were to have, 9 or 10 components and then go look and say, oh, wow, I think actually there's 5 of these that really look robust and sort of have a good, information coefficient across, a large universe of stocks that are being ranked. Well, those are probably your most robust components. And if you want to sort of think about ways to make your model more robust, it's always interesting to look and say, what is the simplest possible implementation of my idea? And can I sort of incrementally justify each of the complexities or improvements that I've added in on top of that? So you might be able, even if you have looked at most of the historical data available to you, you might be able to go back and just push on that thought around overfitting by looking at component by component, sort of how linearly predictive of a wide universe is it, and do you think each component is really robust? So that's all the slides that I put together. Let me hop over and see if you guys do have questions. Yeah, okay, so I'm like pontificating all on like your turnover is all too high. What is a good average turnover range? I think that is a tricky question to answer in isolation, since if you have a very fast moving alpha signal that has a really high sort of return, expected return, you can stomach higher turnover. I think that we have probably been too aggressive in the turnover that we've been ourselves, Quantopian, our research team internally, we've been sort of thinking is viable. So I think that 60% a day, 100% a day, that's definitely really quite high. I think down below 20% a day, even closer to 10% a day, is a little more sane. But I, again, hesitate to give like an exact prescription. The other thought I had on that, while you guys sort of wait for us to kind of keep making our tools more sophisticated, is if you're trying to think about, am I convincing myself this thing will be profitable, but the turnover is so high that it won't actually? Another way to look at that kind of cheaply is to say, well, okay, what if my costs are going to be higher than 5 basis points? So if you run your back test and you say, well, let me use Quantopian's default model. Now let me pretend I paid twice as much or 3 times as much. If you run your own sort of poor man's kind of sensitivity to market impact, and you see that very quickly, your strategy changes from, a positive sharp to a negative sharp, that's a good red flag that your turnover might be too high. So you'd like to see that you could sort of ramp the costs up a bit from where your default is, and you won't see too big of an impact, or you'll see sort of like a linear fall off. If you see it kind of really quickly invert, then you're probably pushing it for what your strategy is going to do. What's the minimum Sharpe ratio that we'll consider? That's a great question. I mean, I think if we can convince ourselves that we think the strategy would return even like, let's say, a 0.5 Sharpe, like post hoc out there in the world, and we think it's additive to the portfolio, we'd be interested in putting it in. So I think on balance, we're less concerned about sort of force ranking the strategies available to us by Sharpe, and we're more interested in a positive expected Sharpe along with all these other things where we're looking for, diversified portfolio, where we think there's some alpha, we think there's some edge over and above the common risk factors, we think the turnover is manageable. We then talk to the person, we think the economic rationale is sensible, kind of go through all those gates. So we're, I think, don't have like a really aggressive cutoff on that. And in terms of the positions, the size of the universe, again, like I think I think in my mind, north of 100 positions in the portfolio is starting to get out of the regime of that's a dangerously concentrated portfolio, which is not to say that, you know, we haven't selected and won't continue to pick individual strategies that do have higher concentration, but less concentration is better. And I also think if you get to, you know, a strategy that looks compelling at, you know, let's say 500 positions aside or even 1,000 positions aside, if that looks good, it's going to be very easy for you to sort of downsample that and get a smaller portfolio that maybe is kind of juiced up, is lower capacity and looks better. But I'd aim for a strategy or an idea that still looks good at a large book size, a couple hundred names, 1,000 names, something like that. Do we accept strategies that are exposed mainly to a few sectors or factors? We've had like kind of a wide range of what we've let in so far. And what we've seen is there's sort of two ways we can go going forward. One is the way that we've put strategies together so far has been extremely standalone. And in that method, we probably have to continue to get like tighter and tighter on our tolerance for how much exposure to any one sector or style we can tolerate. Reason for that is when you run every algo as its own completely standalone little silo, the risk exposures don't diversify, they sum. And so if you have a bunch of strategies that have a little bit of beta, you end up with a portfolio that has way too much beta. We're sort of doing some research internally on thinking about, is there a second way we could take strategies that do have some persistent exposures and couple them together in a way that's a bit more of sort of a hedged basket together? If we go that way, I think we'll be able to loosen the constraints of sort of how much sector or style exposure you can have. But in the way that we sort of launched the portfolio a year ago, you know, those bounds I think need to be pretty tight. So, you know, I think I forget exactly what we say on the site, but something like less than 10% to any one sector, less than 20 or 30% to any one style, and lower is better. Let's see. So what's the next question I can really understand? How do we prove to ourselves that we're not overfitting? Right. So cross-validation tools are out there. Sensitivity analysis is out there. Honestly, I'm kind of old school, and the one that I've always used is just broad holdout data. So when I was at Starmine, we had some rubric where we basically held out half the data while we developed the model. And it was something like, you know, I don't remember exactly, like 2 continuous years, and then every other year and every other month and every other quarter interspersed in some way. So the tricky thing with just sort of using like default data science cross-validation tools is that sort of in generic data science land, there are often sort of some assumptions baked in about, you know, no real autocorrelation and sort of stationary processes, I guess, if that's the right word or right way to say it. Whereas in financial markets, there's all sorts of autocorrelation, and there's all sorts of sort of regime switching and trending behavior. And so I think that the old school way is to sort of think about preserving some of that time structure in your data. And so saying like, hey, let me, again, kind of hold out half the data, but let me do that in a way that preserves some of the regimes and temporal structure. So that's what I've done in the past. Okay, so next question is like, in some cases, is our model too penalizing and live trading might look cheaper? Yes, we've seen both, but it's vastly more common in my experience that when there's a problem, it's that we've underestimated the costs, specifically if, let's say, you know, we're pretending it's 5 basis points, but then your algo's either trading you know, illiquid security or something with really wide spreads, whether that's at that time of day or just it's small cap or it's, you know, in the bottom 10% of our tradable universe. So the problem is when it's underestimating. It is much less common, but I have seen it, that we realize a better price than what we simulate with our current default model. And that's kind of what you want, right? So you'd actually like to build your model, your algo, your strategy, you'd like to build it with a cost model that's like a little bit conservative, right? Because there's other stuff that's going to go wrong, right? So you'd like to sort of be a little bit overly conservative, and then it kind of comes out in the wash. But what I'm worried about right now is that, we've sort of given you guys this kind of one size fits all model. It's definitely better than what we had in place before. But because it's one size fits all, if you're sort of playing in, the lower part of the tradable universe, the lower liquidity part, you may be persistently underestimating, and that is what you want to avoid. Can I give some guidance on expected annual returns and annual volatility to get an allocation? Yeah, so it's kind of same thing as when I answered sort of on the Sharp. So really what we're looking for is not sort of some wildly high or specific returns and volatility target. We're honestly like just looking for things that we think are stable and are going to keep working and are diversified. So if we have not found your strategy yet and gotten to you, it doesn't mean that it's not good. We're working through them, and we're sort of working through them as quickly as we can. But I think again, a persistent Sharp of certainly over 1, if it's realizable, is fantastic, and that's what we're looking for. Right now, again, on this sort of way that we've run things for the first year, where every strategy gets its own sleeve of capital, we cannot stomach a ton of volatility in any one strategy. But that said, I don't think that's like a hard limit. I think it's something we're going to try to keep working to, again, figure out if there's ways that we can like cast the net a little bit more broadly and let things in that are a little bit more volatile. Do we consider the overlap between new strategies and strategies already alive as a factor? Yes, in principle, we do. I think we have not, we've been trading for a year. We've sort of been able to turn on, I would say, kind of like a relatively small number of strategies so far. And so I have not seen our problem being that we've got a ton of the same thing. I have seen problems like those that I've been highlighting of, we do see that there's a lot of stuff that has high turnover and is expensive when we go to try to trade it. But we haven't had like a ton of problems where we're saying, oh, I wish we could put this strategy in, but it's so similar to the one that we already have. Now, going forward, I think that's in some sense maybe a good problem to have. What I would love to see happen is, as we start to bring online, new tradable markets and new data sets through our FactSet partnership, I could see us being able to roll out, more kind of directed and specific contests where we could say to you guys, hey, look, there's this new, tradable market available. Like, we're going to try to see if folks can, compete in a contest to build strategies that just play investing in Canadian securities or developed Europe or Asia. So there, I think we're, that's our goal, is to basically get something that we're happy with in the US markets, where we can continue to add strategies there. But then, all the feedback that I've had talking to other, smart folks and colleagues in the field is, wow, it's going to be so compelling when you take this, really, the Quantopian community that's come up the curve so far and open up for you guys, other markets, asset classes, data sets. I think that's going to open up a lot of green field. So I'm hoping that's not going to be the big problem, our big problem. Can I share current portfolio style exposures? I think I have probably already talked about this, but so definitely we've picked stuff, like I think one thing we've done really well, we have actually picked things that on a returns time series basis have continued to be really consistently low pairwise correlation. But that said, we have let stuff in the portfolio that will take on persistent exposure. So when we first launched the portfolio last year, again, we had, I think, a problem where too many strategies were a little bit long beta. So the portfolio was overall too long beta or too short beta, which sort of could oscillate, and we trimmed those back. Probably the most common style exposure that I see and that permeates through to our portfolio is short-term reversal. Like, I don't think there's anything particularly wrong with that, since I think given the data sets in the market that we've given you guys access to, that's sort of some of the most robust kind of alphas are in, variations on that theme of short-term reversal. So that's sort of what I see. We've kept the sector exposures really pretty tight, and none of those have been kind of persistent in terms of over time. So I think I'm going to do, let's see. Oh yeah, I'm on my last 2 questions. I can get through them. Oh yeah, this is a good one. Okay, can overfitting be tested by running an algo on random data that would simulate? Like, yes, a lot of people do try to do that. my personal feeling on that is that it doesn't feel to me like so satisfying. Like in theory, I think that yes, that works. What I have seen in my own career is like the effort that you go through to generate a synthetic set of data that you feel captures the right market dynamics of real data is like so much more work as to be such vastly diminishing returns versus just holding data aside. So yes, that's a thing that people do. And you could certainly take a look at trying to do that. And I think it kind of should tell you something meaningful. It's just I'm lazy, and that feels like much more work than just holding aside, real market data, since it already has all that structure in it. Would you consider building in an optional forced holdback? So it probably wouldn't be that says, for example, one randomized day of each week. So I don't think that's how I would. Again, like I was talking about, I like these more continuous holdout periods. So it probably wouldn't be like every fourth day. What I think is gonna happen naturally for us is that as we bring online these FactSet institutional data sets, we're going to have a contractual holdback period of the last N months, whether it's 12 or something like that. So that I actually think is going to be really nice for the internal research team. So I think we're going to basically, as we add new data sets, probably deliver them to you guys with some held out data. Now, I also think that it would be nice if we gave you guys like a best practice of, hey, I'm going to go run a back test. Do I have some nice UI tools that say, click, I only want to test on in sample, or, we've even thought about ideas of sort of, letting folks say, okay, I want to like register back tests that I run, and then I want to kind of like click a toggle that says I'm ready to look at my validation data. So I think there's a lot of options where we could try to put that in. And then I think that that's naturally going to come with some of the new data sets that we're bringing online. There's going to be some holdout data, but the internal research team, us inside of Quantopian, we're going to be able to take a strategy. Let's say you've built it and you haven't been able to look at the last 12 months of data. We have access to that and we'll be able to look at that. Okay, so I think I got through all the questions. And if you have questions that you didn't get in time, like I said, I'd love to continue this discussion on the forums thread. I'd love to see more algos shared. We'll try to make this webinar more of a recurring thing. And also I have now some ideas about some analyses that I could do sort of looking across these different strategies. So to the extent that I can pull that together, I'll put my results into that forum thread as well. So thanks so much for joining. I really appreciate it.